Business Negotiation by Chantal O. James. What is business negotiation? According to www.skillsyouneed.com, negotiation is a method by which people settle differences. It is a process by which closure and agreement is reached while avoiding disagreement and dispute. Why should business negotiation be important to you? According to www.entrepreneur.com, negotiation may not seem like an essential part of everyday life, but in the business world is absolutely critical to the success of a business. Poor negotiation can cripple a company just as quickly as losing customers. While most negotiation may seem like common sense, it is not uncommon for people to get caught up in emotion of the moment and ignore basic instinct. Emotion, luck, and magic have no place in a successful negotiation. It takes an iron gut, homework, and street smarts and discipline. During this presentation, you will learn why businesses enter into negotiation in the first place, why the use of income statements, balance sheets, and cash flow statements are important in the business negotiation. What are the roles of lawyers, accountants, CPAs, investment brokers, loan representatives, real estate agents, and appraisers in business negotiation? Why assigners and assignees are required to have separate representatives during business negotiations? What is why is contract drafting key to the parties negotiating? Why seeking representative opinions are so important in evaluation and business negotiation? Why is due diligence the most critical part of the negotiation process? And why are real estate negotiations and commercial real estate negotiations similar? In addition, you will learn how do the offer and acceptance positions differ during the business negotiation process. What is venture capital? What role does venture capital investment play during a merger and acquisition negotiation? Why merger and acquisition negotiations are not complete upon signature of closing terms? When are the terms of a merger and acquisition agreement considered closed? Why do businesses enter into negotiation in the first place? When a business enters into negotiation, they are often seeking to gain leverage of investment through ownership of a smaller operation. This is usually accomplished through one of the following. The ownership could be acquired through venture capital, investment in infrastructure to adhere to a parent company, or through private offer terms by a business advisor. During this presentation, we will cover some of the business negotiation topics such as real estate or commercial real estate negotiation, commercial business negotiation, purchase of fixed assets or inventory, purchase of land, purchase of ownership, and warranty of assets or inventory. Real estate or commercial real estate negotiation. During a real estate negotiation, the leaser agrees to transfer ownership of the property in exchange for leverage of funding. The terms to this agreement can extend for a period of years and is not complete until the lessee has met the mortgage terms. The pricing terms are usually set with a note and require several years of interest in exchange for time and requirements. The most common requirements for real estate financials are that the parties agree that the estate is in terms with inspection and free of hazards. If there are any hazards against the property, the pricing is entitled to be reduced reasonably. The down payment to the state has to meet agreement terms and arrangements. If a note is required as a loan, the borrower has to meet all credit requirements for the property. Transfer of ownership shall be met upon full payment of interest. Upon closure of terms and transfer of ownership, the leaser or owner has agreed to keep the property under approved management. Commercial business negotiation. Commercial business negotiation works much the same way as real estate negotiation. In a commercial negotiation, the parties agree that the value of the business shall be issued to the company in exchange for payment. The company usually receives ownership or full management as an entity upon contracting. These entities are usually outsourced to options finance such as merger and acquisition, venture capital, or corporation over LLC. The most common requirements for commercial business financial statements are: the business must have good standing debt and payment funding. And much like in real estate negotiation, if any outstanding liens are found against the property, the parties are required to reasonable reduction in pricing. Much like a party must have good credit in real estate, in business, adequate flow of funding must be represented by the cash flow statement. The business must have reasonable tax standing to earnings, borrowing, interest, tax, debts, and assets. If the business is acquired through venture capital, it must adhere to the parent's company infrastructure through venture funding. If the property is found to be illiquid, the business must seek closure through professional appraisal. Purchase of asset negotiation. When a leaser purchases an asset, they are usually required to submit collateral. Collateral is used as payment until the asset is fully claimed. The collateral usually increases the flow of funding before the asset is fully owned. When the asset negotiation is complete, the full funding is received and the asset is transferred. The most common requirements of asset purchase financials are: the collateral must be recorded under balance sheet financials. Any depreciation in the value must be reduced as recorded. If there's any value to be written off against the asset, it is recorded as a plus on the balance sheet. Any taxes on amortization must be recorded as a reduction. Upon transfer of the asset, all debt under the flow of funds are completely written off. Purchase of land negotiation. The purchase of land is usually done through a mortgage. The buyer is required to submit a down payment, a monthly payment towards the balance, and a payment of interest value. The terms of the land are not fully met until the balance is fully paid. These terms are usually leveraged by the seller, and any amortization on the land shall be considered earnings on land ownership. The most common requirements on land purchase financial statements are: much like in real estate, any liens against the land must be inspected against value. Much like in real estate, the buyer is required to submit proof of financial that the receipt agreement for credit loan funds is used towards the purchase of land. If there's any proven change in appraisal value, the terms of the mortgage payment can be refinanced. Unlike purchasing of real estate property, the purchase of the land is usually transferred tax-free. Any leverage in earnings received by the seller is considered earnings on cash flow. Any amortization on land ownership shall be earned via tax credits. Purchase of ownership. During a purchase of ownership, the purchaser is required to submit consideration in exchange for either stock, bonds, or no ownership. Ownership ends upon transfer of funding. The purchaser holds the ownership as interest on consideration. If the owner receives more than what was originally invested, it is an earned income. If the owner receives less than what was originally invested, it is a loss. The most common requirements on purchase of ownership financials are: the owner is using the loan funding as consideration, must submit to the creditor proof of financials. Earnings are recorded on the income statement and balance sheet. Any preference of ownership depends upon the valuation of the stocks, bonds, or notes. Any interest on investment is leveraged and recorded as funding on earnings of cash flow. Taxes must be paid on the earnings in accordance with preference of the ownership investment. Warranty of asset or inventory. With an asset or inventory warranty, the parties agree that the assets or inventory are transferred without damage, loss, or failure to refund. Any damage, loss, or misplacement under the warranty shall be liable for refund, replacement, or repair. By signing a warranty, the parties agree to only the provisions covered under the warranty. Common requirements of warranty financials are: all defects in assets or inventory shall be covered under cost of goods sold under the balance sheet. Cost of goods sold is leverage is earned through sales and pricing demand. Inventory stock is replenished quarterly on the balance sheet. Assets, receivables, or inventory are not fully collected until the asset or inventory is transferred without any damage, loss, or misplacement. The roles of lawyers in business negotiation. The roles of lawyers in business negotiation include advisement on contract provision, resolution of any disagreements via drafting or mediation, representation in court, representation on agreement issues, and futurization on contract provisions. How do the roles of accountants and CPAs differ? Accountants compose financial statements, provide records on investment funding, provide reporting to chief financial officers, and enforce compliance with General Accounting Association practices. CPAs are known as certified public accountants. They are considered a type of accountant. They also enforce General Accounting Association practices. They provide negotiation on tax exemptions and representations with lawsuits and liens. The role of investment brokers in negotiation. The role of investment brokers on negotiation include advisements on stock, bonds, and note preferences, professional opinions on marketing and investments, representation with loan contracts and agreements, repurchasement of stock, bonds, and notes, refinancing of assets and real estate investments, and due diligence on mortgage offering terms. Loan representatives. Loan representatives provide due diligence on lending and investment offers, review and advisements on financials, leveraging options and investment refinancing, assessment of creditworthiness of mortgage, stocks, bonds, and note preferences, and offerance of asset purchase funds. How do the role of real estate agents and appraisers differ? Real estate agents provide offering on custom mortgage options, renegotiation and refinancing on mortgage terms, investments in collateral funding, advising on real estate financial statements and tax credentials, and amortization payment options. An appraiser is considered an accredited real estate agent. They provide valuation of assets on real estate, professional advisement on personal financial planning, and mediation for assets and investments during inheritance. Why are assigners and assignees required to have separate representation during business negotiations? According to the U.S. Constitution statute, parties to a business negotiation have the right to due performance of materiality. That means both parties are entitled to submit their agreement terms via a qualified professional to the best of their knowledgeability of the terms. The terms may be mediated before they are agreed on by both parties and considered a required provision. Why is contract drafting considered key to the parties negotiating? The terms to a contract are deemed upheld once the courts rule it as reasonable, and if it is not correct, it may lead to an unfair ruling. If a ruling against a party is considered unfair, it may only be changed by appealing to a higher court in the Supreme Justice system. The party is usually required to have a lawyer as a professional representative who is knowledgeable about the case provision precedents and is able to revise the drafting. Why is seeking a representative opinion so important in business negotiation? The parties negotiating need to be knowledgeable to the best of their expectation in order for their statements to be considered legitimate. Otherwise, the parties may seek a second opinion. Knowledgeability is essential to reaching common ground during the negotiation. Why is due diligence the most critical part of the negotiation process? With due diligence, the receiving party researches the offer to find if it is legitimate or if it has the best offering terms. If the offer is legitimate, the receiving party may waiver the rights of the offer. If the party has not done due diligence during the process, that party may experience difficulty in waiving the offer. So what do businesses look for in offers versus acceptance? Offers, businesses usually look for offer terms complying with authority, encouragement of trade-off terms, seeks more than expected, not accepted unless offer terms are settled, attempts at renegotiating a small concession. During acceptance, a business usually looks for seeking middle ground on terms, negotiating with confidence, using appropriate language and verbal cues, options to walk away or waiver rights, avoidance of greed, and compliance with targets and goals. Similarities in real estate negotiation and commercial negotiation. When a party decides to invest in a real estate property, the process is no different than when investing in commercial real estate. The inspection, offer process, and marketing cycle share similarity whether you invest in real estate property or commercial real estate. The differences usually exist on the terms and representation requirements. What is venture capital? According to www.investopedia.com, venture capital is a form of private equity and type of financing that investors provide to startup companies and small businesses that are believed to have a long-term growth potential. What role does venture capital investment play during a merger and acquisition negotiation? Merger and acquisition firms are considered the cousins of venture capital funds. A merger and acquisition firm typically invests in a profitable company, while venture capital funds invest in startups. The merger and acquisition firm usually makes the acquisition by loaning the company and/or arranging an injection of debt into the company, while a venture capital fund typically buys equity in the startup. Why merger and acquisition negotiations are not complete upon signature of terms. The signing of business negotiation terms does not complete the negotiation process. The receiving and the giving party have to continue to negotiate the terms until agreement has been totally mediated. Processing a merger must comply with the parent company's infrastructure to complete the terms. When are the terms of a merger and acquisition agreement considered closed? The terms of a business negotiation are not considered closed until the passing of the merger terms is complete. In other words, the agreement is not complete until the parent company has control of venture capital compliance and funding. If the terms are not closed, investment will deem to be having been a partial investment of merger terms. This concludes the lesson. You have successfully completed the lesson on business negotiation.